In this video, I'm going to be talking about installment notes. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. Very similar to mortgage payments or car payments, where you buy a car and then you make a payment over a period of, let's say, 3 years or 4 years, whatever the length of this payment. But one thing that we have to pay attention to is that these installment notes are usually equal in value. So what I pay at the very first payment is equal to the same amount that's paid at the very end of the payment. So each note payment includes two things. The first thing is a payment of a portion of the amount initially borrowed, called the principal, and payment of interest on the outstanding balance. So even though the total amount paid at the very beginning is the same towards the end, the amount of principal compared to the amount of interest varies as we go through these payments. So at the very beginning, the amount of interest is very high compared to the principal, and as we get closer to the end of these installment payments, the amount of the principal gets to be much larger compared to the amount of interest. So at the end of the note's term, the principal would have been repaid in full, and that's how we settle our debt. So installment notes are often used to purchase specific assets, such as equipment, and are often secured by the purchased assets. So usually have like a mortgage, for example, and there's a lien on the house. If we buy a car with payments, then we usually don't have the title of the car until we complete the payments for the car. So if the borrower fails to pay the note, the lender has the right to take possession of the pledged asset and sell it to pay off the debt. Installment notes that are secured by purchase assets are sometimes called mortgage notes. So now let's see the issuance of the note. So when an installment note is issued, an entry is recorded debiting cash and crediting the notes payable. And that's a very traditional kind of journal entry, and I hope by now we are very comfortable recording these kind of journal entries. So let's see an example. Assume that on January 1st of year 1, Lewis Company issues the following installment note to City National Bank. The principal amount of the note is $24,000, the interest rate is 6%, the term of the note is 5 years, and the annual payments is equal to $56.98. In this case, we're given the annual payment, so I think this simplifies a lot of our calculations. So on the date the notice issued, we are going to debit cash for the amount of the note, or how much we received for the note, which is the $24,000, and we credit the liability, which is notes payable, for $24,000. Now let's see the periodic payments. The preceding note payable requires Lewis Company to repay the principal and interest in equal payments of $56.98 beginning December 31st of year 1 for each of the next 5 years. In other words, year 1, year 2, year 3, 4, and 5, you're going to make equal payments of $56.98. And if we do simple math by taking the $56.98 multiplied by 5, it's going to be more than the $24,000 that we borrowed. And the reason it's more because there's interest involved in this. So each installment note payment includes an interest and principal component. The interest portion of an installment note payment is computed by multiplying the interest rate by the carrying amount or the book value of the note at the beginning of the period. And by the way, the term carrying amount and book value, they usually have the same meaning. The principal portion of the payment is then computed as the difference between the total installment note payment, cash paid, and the interest component. And we'll see this how it works in the following table. So you see here we have this table that has for the years at the very left column, and then we have 5 main columns like labeled A, B, C, D, and E. The first column here, A, shows the carrying amount or the book value at the beginning of the year. And then the last column, which is column E, shows the carrying amount at the end of the year. And then we have the note payment, which is the cash payment, and you can see that these are equal payments, so this amount is not going to change, and you can see the total is $28.49 or $490, and that's more than the $24,000, which is the amount that we borrowed. And then we have the interest expense, and we'll see how this is calculated. And then we see the decrease in the note payable, or in other words, the payment in principal. And then the carrying value at the end of the year. So we start with a carrying value of $24,000. We know that we make a payment of $56.98 every year. The interest is calculated as the carrying value at the beginning of the year multiplied by the interest rate, which is 6%, and that has to be the effective interest rate or the yields, and that would be $14.40. We subtract the $14.40 from the amount that we paid, and that will give us the amount of reduction or decrease in notes payable. So now we reduce the $24,000 by the $42.58, and we get the new balance here, which is $19,742. We take the $19,742, and that would be our beginning balance for year 2. Always remember that. Ending for 1 year is the beginning for the following year. We multiply that by the 6%, we get the $1,185, and we know that we make a payment of $56.98 every single period. So you see here the amount of interest went down slightly, and we subtract this from the $56.98. We get the amount of reduction in the note, $45.13. And you can see here the amount of payment that goes towards the principal is getting higher now. Subtract the $45.13 from the $19,742, and you get the new carrying value or new book value, which is $15,229. We do the same thing. Take the $15,229 to year 3, and then we take this amount again, the $15,229 multiplied by 6%, that's $914. That's the amount of interest expense, and you can see it's declining year after year. We subtract it from our regular payment, which is the $56.98, and the difference is the amount that we reduce our note payable with, which is the amount of our principal payment. So our principal payment is going to go down by $47.84. We subtract the $47.84 from the $15,229, and we get the $10,445. I like that they label column D and E, where they explain how we got the number, which is column B minus C for column D, and for column E it's A minus D. Then you take the $10,445, you move it to year 4, you do the same thing until the end. The carrying value has to be 0. So that way you made a payment for the total value of your principal, which is $24,000. This is the total amount of payment for interest, $44.90. So if you add these together, that would be the $28,490, which is the total amount of cash payments for this note, or for this installment note. So let's see how the journal entry would look like. And here we're looking at year 1. The entry to record the first payment on December 31st of year 1 would be as follows. We're going to credit the cash, and I'm starting with the cash because that's easy to remember. We make the equal payment every single year. So cash, we have $56.98. And then we have the interest expense, the $14.40. If I go back to our table, you can see that the amount of interest expense was $14.40. Expense is always on the debit side, so we have interest expense on the debit for $14.40. And then we have the reduction in the notes payable by $42.58. And again, we got this from column D, $42.58, which is the amount of reduction in the principal of the note. So that's for year 1. For year 2, same concept. We're going to credit cash for the exact same amount, $56.98. The amount of interest expense is slightly lower. It's $11.85, and I'll go back to the table. You can see that it's $11.85. And the amount of reduction in the note based on the payment of the principal, it's $45.13, and you can see that here it's $45.13. And then for the very last year, year 5, again, the cash is exactly the same, $56.98. The interest expense is the smallest, $324, and the total value of the payment towards the note payable is $53.74. And by that time, the notes payable balance should be equal to 0. So after the final payment, the carrying amount on the note is 0, indicating that the note has been fully paid. In the next video, I'm going to be going over contingent liabilities, and we'll finalize the chapter with this discussion.